Good morning, sir. Myself Karthik Sivat and my friend Kaustubh Kaivar, and we are presenting our EL experiential learning on finance, which is the case study on Nandini KM. So these are the contents. So first we were talking about the overview, then organizational structure, vision, product portfolio, strategy, sales, financial analysis, vertical analysis, horizontal analysis, profitability analysis, solvency analysis, and liquidity analysis. So this is the picture of KMF Velhanka. So the overview of the organization is that this is the Karnataka Cooperative Milk Producers Federation, which is KMF, which was established, and this is the second largest dairy cooperative in the country and the market leader in the South Indian dairy industry. So KMF is a unit established in 1984, which manufactures and supplies milk products, milk powders, ice creams, yogurt, curd, flavored milk, and other milk products. This is the organizational structure of the KMF, which is more than 2 million milk producers per farm, will send to 100 plus dairy cooperative social at village level, and 16 milk union at district level, and milk federation at state level. So this is the overall organizational structure. So what is the vision and mission of the company? So the vision is to march forward with a visionary zeal, which will make KMF a trailblazer of exemplary performance and achievement, beckoning on milk federations in the country in pursuit of total emulation in the goods and drinks. And the mission is heralding economic, social, and cultural prosperity in lives of our milk producer members by promoting vibrant, self-sustaining, and holistic cooperative dairy development in Karnataka state. So this is the product portfolio of the company, which is the mother dairy is the unit of under Karnataka Cooperative Milk Producers Association (KMF). So the KMF coordinates with the unions and consumer market to produce products which are sold under the name of Nandini. So these are the products that are that the company has. So firstly, it has pasteurized toned milk, then homogenized cow's pure milk, Shubham pasteurized standardized milk, double toned milk, and Nandini curd. So these are the USP in milk and milk products, the powders that they have. These are the ice creams and frozen desserts that popularly Nandini sells, and this is the pricing strategy that they apply. So according to this, the Nandini toned milk is sold at 42 rupees per liter. Homogenized covers pure milk is sold at 46 rupees per liter, and Shubham pasteurized standard milk is sold at 48 rupees per liter, and Nandini curd at 50 rupees per kg. So in the ice cream segment, Nandini keeps for regular ice cream penetrative prices and competitive prices for special flavors. So the fastest selling ice cream is Chocobar is 60 ml is priced at rupees 15, while most private dairy and ice cream brands sell it for 25 to 30 rupees. So they make a huge profit margin here in this product. So these are the distribution channels. They are present over Karnataka, Tamil Nadu, Andhra Pradesh, Telangana, and Maharashtra. So uh, they have separate Nandini shoppies, that is separate shops which they sell it through franchisee model. So this is the promotional marketing that the company does for it, and the Nandini uses different marketing strategies in the market. So it uses different modes to promote products like magazines, hoardings, banners, dealership displays, newspapers, television, radios, and social media. So these are the magazines that are popular in Karnataka. So these are the hoardings. So these are very effective ads, which are very large hoardings, and the ad message are put into the much clustered areas or on the sides of the road. So these are designed in such a way that just to remind about the brand. Usually, this doesn't give the detailed information about the brand, but to remind about the brand and to show the availability. So the next means is the newspaper advertisement and newspaper insertion. So basically, they put their ad in the newspaper, and people see it, and they become popular. So the next thing is dealer displays. So the dealer displays are the display boards given by the companies for displaying the product information. So they are exclusively given to dealers only, which contain lighting facility, which make them clearly visible at the night also. The next thing is television and advertisement, which is the more conventional method of advertising. So the company's main focus for mass advertisement with more engagement is through electronic media, specifically it is through TV advertisements and shows. So KMF does kitchen programs on a TV like Nandini Adugi Mane and in private Kannada channels, which are exclusively sponsored by KMF, which create awareness about the Nandini products and increasing the brand of image of Nandini. So the another thing is social media marketing, which the company focuses on Instagram and Facebook, both channels they had. And Instagram, they have 4,000 followers, which is the last post is about 2 years ago. And there are 8,100 followers on Facebook. So we'll be talking about the competition analysis. So the dairy industry market, which is the milk production in Karnataka, mainly consists of cow milk and buffalo milk. So according to the report, Karnataka dairy market size, which has reached to 932.1 billion INR in 2022, will reach about 2,122 billion INR in 2028. So the major competitors of KMF in milk products and their market share is that Nandini holds the biggest market share, which is 91% in Karnataka, and its competitors are Heritage, Dodla, Arokya, etc. So this is a distribution network of milk products in KMF versus its competitors. So Nandini maintains a very strong presence in the southern regions of India and also few overseas markets, say Singapore and UAE. These include small retail units called the Shoppies and ice cream cafes. The distribution networks of its competitors, which is Heritage and Dodla, are very less as compared to what is that of Nandini. So we'll be talking about the market assessment for KMF. So here we'll be talking about the total addressable market. So the milk industry in India is massive with highest generated revenue from the dairy, which is the total addressable market is 54,000 crores. Then comes the serviceable addressable market, so which is not that much. So serviceable addressable market, and then we'll be talking about the serviceable obtainable market, which is 932 crores. So now talking about the SWOT analysis of KMF, which is the strength, weakness, opportunities, and threats. So we'll be talking about the strength, which is the brand image. With the brand image is very nice. So the large procurement base, it has a very big investors which are invested in this company, infrastructure, and high market share. Its weaknesses comes to lower profits, lower packaging standards, and bureaucratic function. Its opportunities for this company are there is a huge market demand and new geographic lead. And the threats is increased private players and no new product line, low commission for retailers. So talking about the sales of the company, the total sales revenue during the year is around 809 crores, which is more than 7% of the previous year. So the most sold product is stone milk and contributes to around 58% of the total sales revenue. Inter-unit sales amount is around 124 crores and 25 lakh 27,800 rupees. And other sale like packaging material and all constitute under. So it is also preferred by hotels and bakers. So this is the visual representation of the inter sales data. We'll be talking about the financial analysis. Firstly, we'll be talking about discussing about the working capital of the company. So the working capital current liabilities are around 42 crores, 79 lakhs, 9,000, and current assets are 81 crores, so 68 lakhs. So the net working capital is the difference between the current assets and the current liabilities. So it is around 38.89 crores. So the mother dairy, according to the financial statements of 2021-22, have a working capital of 38.89 crores, which is amount available to the firm from its day-to-day operation and to meet its short-term obligations. So although the working capital is less than the current liabilities, it is definitely an indicator of the firm's good financial position. So these are the financials of the fixed assets that the company is having. So this can be presented graphically using this presentation, which shows the fixed assets in the year 2021-22 and depreciation reserve. Now I'll be talking about the vertical analysis of 2020-2024. So here's the vertical analysis of the assets section extracted from the balance sheet of the year. And the vertical analysis involves stating all the line items and in a financial statement as its percentage from the total assets. If it's a balance sheet item or a percentage of revenue, it's from income statement item. So the vertical analysis is usually used for comparing companies of different size and nature. So this is the pie chart that we have used. So it shows the assets of Mother Dairy on 31st March 2022. So it shows that the total assets are around 50% and the major portion is fixed assets. Now talking about the horizontal analysis, which is the balance sheet. So the horizontal or the intra-company analysis refers to comparing the financials of a firm with its performance in the past years. So the base year is 2027-2018 and the financials of all the years with the presented as the percentage of the corresponding figures in the base year. So here we have compared 2017, 18, 18, 19, 19, 20, 2021 and 21, 22 of all the fixed assets, inventory, sundry debtors, cash and bank balances and loans and advances. So we can see that the total assets are increasing year by year. So these are all the data. So here graphical analysis of the balance sheet can be shown. Here the analysis of the year 2012 and 2013 is shown. According to all the assets that the company is having and all the expenditures it makes, the graphical analysis can be shown. So the key takeaways from the balance sheet analysis tells us that the company assets increased by 7.6 percentage primarily due to an increase in the non-current assets, and the company's liabilities decreased by 1.4% primarily due to the decrease in the non-current liabilities. So the company's shareholders' equity increased by 2.86 percentage primarily due to an increase in the reserves and surplus. So overall, the balance sheet of the market shows that the company's financial position improved in March 2013 compared to March 2012, which is a good sign for investors. So now we'll be doing the data analysis and interpretation. So the data analysis and interpretation is the process for assigning meaning to the collected information and determining the conclusion, significance, and implications of the finding. The data used here are various financial statements of the cooperative society to draw useful interpretation. The analysis will be done using the following tools, which is data visualization, descriptive statistics, and financial analysis, which is the liquidity, solvency, and profitability analysis. So the main aim is to do financial analysis on the financial performance of the cooperative society. The financial analysis of the cooperative society can be conducted in three main stages through which the whole cooperative society will be covered. The financial analysis can be divided into three stages, and the stages are profitability analysis, solvency analysis, and liquidity analysis. So this is the this can be shown as a flowchart. With it is the data analysis and interpretation can be divided into financial analysis, and there are three types, which is liquidity analysis, profitability analysis, and solvency analysis. So firstly, talking about the profitability analysis. So profitability analysis is a financial assessment process used to evaluate the ability of a company or a business to generate profit from its operation. It involves analyzing various financial matrices and ratios to understand how efficiently the company convert its revenues into profits and to identify the drivers behind its profitability. The primary objective of profitability analysis is to assess the overall financial performance of the company and determine its capacity to earn profits over a specific period. So the key components of profitability analysis include gross profit margin, which is the indicates the percentage of revenue that remains after deducting the direct cost of the goods and services sold. Second is net profit margin, which is the net profit margin that represents the percentage of revenue that remains after all the expenses, including operating expenses, taxes, and interest, have been subtracted. The third is return on investment. ROI means the profitability of an investment by comparing the gain or return on investment on it to its cost. So it is used to evaluate the efficiency of capital allocation and investment decisions. The next one is return on equity, which is ROE, which assesses the profitability of a company from its perspective of its shareholders. So it shows how much profit a company generates for every rupee of its shareholders' equity invested. And the fifth one, or the last one, is the return on total assets, which is also known as the return on assets (ROA), is the financial ratio that measures how profitable a company is related to its total assets. So talking about the net profit margin is it can be calculated mathematically using profit after tax upon turnover. So the net profit the margin is a measure of the percent of each rupee of turnover that flows through the shareholder as net income. A higher profit margin indicates a more profitable company that can be better control over its costs compared to its competitors. So the profit margin establishes the relationship between the PAT and turnover and indicates management's efficiency in manufacturing, administration, and selling the products. So these are the new numbers. So by this analysis, we have reached to a conclusion that the rise in turnovers can be clearly observed from the table clearly. So the increase in the turnover over the years in the positive sign of the expansion of business cooperation in the society. So the table also shows a rise in the profit of the society over the years. So the society must increase its profit earning from business operation to achieve a better net profit margin, as typical values in dairy sector is around 15 to 20%. So the profits of the society are continuously rising in the past 3 years, which shows positive trend in the profits of the society. So the increase in the profit of the society is an indicator that the cooperative society is earning well from its business operation. So this is the graph, which shows the profit after tax and turnover. It can be seen that profit after tax is increasing year by year, and turnover is also increasing year by year. So these are the graphs from which line graphs by which we can tell that what is the current situation of the company. So we'll be talking about the return on investment. So ROI is the net assets are the total of all the fixed assets plus current assets less current liabilities, excluding bank loans. So the return on investment is earnings after tax divided by net asset or capital deployed. So managers generally prefer this ratio to be very high for the firms. So high ratio can also mean that the firm is failing to replace worn out assets. So these are the these are the data. So the analysis tells that the table also shows the rise in the profit of the society over the years. The rise can be observed from the table clearly. The increase in the profit of the society shows clear sign that the society is earning well from its business operations. So the increasing trend of earning after tax gives a clear indication of the cooperative society is earning well from its business operation, and increasing the trend of capital employed shows a continuous growth in the investment of the owner's fund. So these are the charts. Now my friend Kaustav will continue with the solvency analysis.
Yeah, thank you, Karthik. Good morning, sir. I'm Kaustubh, and I'll be talking about the further analysis, starting with solvency. So, solvency analysis focuses on solvency ratio, which is one of the more one of the other ratios that we use to measure the ability of a company in terms of handling and meeting its long-term debts. Moreover, this solvency ratio quantifies the company's size after tax income, so not counting other depreciation expenses compared to total debt obligations of the firm. So provides an assessment of the likelihood of a company to continue congregating its debt obligations. So solvency refers to the ability of a concern meet its long-term obligations, and then it also refers to the long-term indebtedness of a firm, like debenture holders, financial institution providing medium and the long-term loans. So we're going to be looking at how the company has performed in terms of debentures, long-term loans, how it is focusing on credit and other other total size of the companies after tax, and not just, and we ignore all the non-cash depreciation expenses, other things such as long-term borrowings, repayment of principal amount by maturity and all that. So there are particular tools we can use for solvency of cooperative society, since Nandini KMF is a cooperative society. So there is ratio and trend analysis using debt equity ratio, proprietary ratio, interest coverage ratio, and capital gearing ratio. So next slide. So debt equity ratio is also known as external internal ratio, external internal equity ratio. It calculates the relative claims of outsiders to owners. So it is basically outsiders funds divided by shareholders funds. So it is basically total debts because of the outsider funds divided by shareholders funds, is equity. So this ratio, whether short term, long term, or whether in debentures or bonds, will tell us equity share capital, preference share capital, and all that, and will tell us about the reserves that represent accumulated profits and surpluses, like reserves for contingencies. So using this ratio of outsider fund is to shareholders fund, we have been able to calculate the debt equity ratio. So naturally, greater the outsiders funds than shareholders funds, we will be encountering much more larger debt than equity. Clearly, we have seen that Nandini has maintained a much higher equity than debt. So this is benefiting their average and their totally adding up, making a better debt equity ratio, since it should be less than 1. This is a good debt equity ratio they've accumulated over the last 4 years. Next slide. Yeah. So, like I mentioned, the debt equity ratio is always low, and this shows that they're relying less on their outsiders funds. So this is a good thing. And their all-time high was only 0.2944, and is also considered to be very low. So it is not, they're relying much lesser on the outsider funds, as I said, as opposed to the shareholders' equity and funds. This means that they're having a very, very small amount of debt compared to equity. That's a very good sign as well, because that usually indicates, as we know, that the company is doing very well financially. They're financially secure, have a strong balance sheet as well. So, and it's very low. The ideal debt equity ratio is 2:1. It's much lower than that. So we're like doing good. So this is the trend analysis of change in outsiders and shareholders fund ratio in terms of percentage over last 4 fiscal years, as you can see. So as you can see, the ratio has still been maintained over the last 4 years, and there's no loss in this ratio. Yeah, next slide. So these are all the graphs you can infer from. I can go to previous slide and just show the graph how they look like. Yeah, this is the ratio of outsiders fund, shareholders funds, and then this is the debt equity ratio for 4 years and all that. So yeah. Now we're going into proprietary ratio. Proprietary ratio is shareholders funds divided by total assets. So this tells us about the long-term solvency of a firm, and higher the ratio means higher. It is a better long-term solvency position of the company because it means it has more assets that are funded by shareholders, and it is less reliant on debt from outsiders to finance the operations. Lower profit ratio means it has more assets funded by debt. So such companies are more reliant on debt to finance their operations. So higher the profit ratio, the better. So as you can observe, shareholders uh, fund to total assets, it has been lesser, but it has also improved from 2018 to 19. It has been consistently improving 0.69, 69% to 67, 71, and finally it has reached 100%. So it means it is using, if you say 100%, we can say that by 2021 to 2022 is using, it is completely reliant on the shareholders fund in their total assets, and there's no debt reliance that they have had over the years, and they have a healthy ratio on healthy percentage of 77%. So as you can see, it shows the rise in the investor trust and increase in investment. So we can say that increase in the shareholder fund, as we talked about, can clearly be inferred. So it leads to the conclusion that owners have less stake in the total assets. So this is a good sign because, this is not a good sign because a cooperative society must always increase the stake of its stakeholders in its asset value to be more solvent. And in terms of long-term solvency, it is definitely not a good sign, even though there is total of 100% shareholders fund. In that context, it was a good thing. But in terms of the fact that there is no that there's lesser stake by the owners themselves, it's not a good thing for the cooperative society. So because there should be higher stakes in the stakeholders themselves. So this is a not a very great trend to observe. As we can see the percentage in table 2.2b. Next slide. So by looking at that, we can see that there is upward trend of shareholders fund and total assets which can be observed. So higher the ratio implies there's lesser likelihood of insolvency, and the management has to use lesser debts and vice versa. That's actually a good thing because there should be increase in, but there should be, however, increase in stake of shareholders in the total asset because higher the ratio of shareholders, better is the long-term solvency. So as you can see, shareholders fund has increased throughout. This is a good sign in Nandini's growth. Next slide. So this is showing the proprietary ratio, and we can see that it is increasing. There is a downside that there is lesser stakes by the company owners themselves, but the good side is also that there is improved shareholder ratios. So next slide. Now we'll talk about interest coverage ratio. Interest coverage is net profit before interest and tax, which is PBIT, and divided by fixed interest rate charges. So this ratio indicates number of times, as it says in the slide, this number of times interest is covered by the profits available to pay. The interest charges generally higher the ratio means safer are the long-term creditors of the company. So as you can observe in the table, we have to take net profit PBIT, which is before interest and tax, then divided by the fixed interest charges, and we can see that it has always been positive. It has in fact been a much larger value. So to infer this table, we can proceed to the next slide. You can see that there is increase in the net profit clearly. So this shows there's a clear sign that society is earning well from business operations because it is about net profit PBIT before interest and tax, and then divided by fixed interest charges. So the higher this ratio is, more secure the lenders would be. That is what it implies. Before the respect to the periodical interest income, the present ratio of the cooperative society is comparatively good. The present scenario is a good sign as far as long-term solvency is considered. So that is a good trend as far as we can observe. There's a higher, there's always been much higher than 100%, the total ratio. As you can observe, this is the same thing tabulated in the form of a graph. When we take the ratio of P bit by fixed interest charges, it is clearly always a positive ratio. It's much higher. It is usually around four or so, the total ratio. So it's an increasing trend, but the increase in net profit should be comparatively higher for to fixed interest charges for better long-term solvency. So the cooperative society, as we can see from these inferences, must also increase their profits from operation. Next slide. Now we'll talk about liquidity ratios using and perform liquidity analysis. These are also termed as short-term solvency ratios. What we saw before were long-term solvency ratios. Liquidity is talking about the extent of quick convertibility. So it's talking about the short-term solvency and quick convertibility of assets into money for paying obligation of short-term nature. So liquidity ratios are useful for indication of firms' ability to meet these current liabilities. So yeah, most of these greater firms, the greater level of firms' current asset relative to current liability, the greater is the firm's liquidity. So higher liquidity is met by higher asset this thing. So yeah, we don't want shareholders may not want too much liquidity, so it depends on all those things. Firm can never be too liquid. Since current ratio do not earn high returns for the firm, this reason firm attempts to avoid both insufficient and excessive liquidity. It should be both in the middle. So we'll look at current ratio and net working capital ratio. Next slide. Yeah, so NWC ratio, net working capital ratio, is NWC divided by net asset. So this is the table inferring the same thing. And we can see that this is a value much less than 1. So you can observe that there is an uneven rise though in this network capital of the cooperative society. So that is actually not satisfactory. It's not a very good number. So shows inability of the cooperative society to meet day-to-day requirement. And we can see that as per present situation, net working capital of cooperative society is not at all satisfactory as companies in order to meet day-to-day requirement efficiently. So there's actually a problem if you look at change and in the percentage. You can infer this further from the graph. You can see that even though it is slowly improving, it should actually improve much more because the net working capital is like very less compared to the net assets of the company itself. It's a kind of a downward negative trend, but it has improved over the years. So it is a good work in progress. This is the ratio over 4 years and how the percentage changes happened over 4 years. Moving on, we have the Power BI dashboard. So we worked on Power BI for data visualization and analysis for all the results we have tabulated so far in order to effectively represent the data. This was our phase 2 work. So my friend Karthik will be talking about this.
So this is more about the profitability analysis dashboard that we have created. And this dashboard basically gives the difference or the versus between two different parameters. So the first one we have done is earnings after tax versus the capital employed. It is the ROI or the return on investment. And we have tabulated the graph on Power BI. And it can be from profitability point of view, the profitability position of the cooperative society is satisfactory. And earnings after earnings after tax and capital employed graphs can be shown on the first graph. And secondly, we have done the profit after tax versus turnover, which is the net profit margin. And here from this data, we can see that the average of profit after tax is being increased from 2018 to 19 to 2020-21, and then suddenly it is decreasing a little bit. And another thing is that the average of the turnover is increasing each and every year from consistently from 2018 to 2022. So the third one is the PAT versus net worth, which is the return on which is the ROE. And here we can from this graph it can be visible that the average of profit after tax, which is the PAT, is increasing from 2018-19 to 21-22. And the average of net worth is also increasing from 2018-19 to 21-22, which is a very good sign for the profitability analysis of the cooperative society. So this graph will be explained by Kaustup.
Yeah. So here we have debt equity ratio. So we know that lower the ratio, the better because we want more equity and less debt. So the same thing has been tabulated using the solvency analysis for the same. We have done that for using Power BI. And here we can see that over the years, the equity has grown massively. So the debt has also fallen. If you can see 0.23, 0.23, and then it increased a little bit in 2019 to 2020, and then again it fell off by 2021 to 2022. So this is a good indication. This is healthy. And then we look at proprietary ratio, as I was talking about in the long-term solvency analysis. As we observe, there is average of shareholders fund and average of total assets have been analyzed using Power BI, and then we have the average of the proprietary ratio. And if you look at this further, we see that the uh, the ratio has successfully increased. It has become 1 in the end. That means the company is fully relying on their shareholders, as we saw. Only problem is that they need to rely more on their stakeholders. But in the context of shareholders, this is a very healthy growth. Then we look at net profit PBIT divided by fixed interest charges for interest coverage ratio, and that we have seen is always been a very high positive number. Has been like, as you can see, 2019 2020 it has been 3.77 by dividing the value 4 lakh, the 491, that one divided by the bottom one, and then again we see it has actually increased in 2021 to 2022. It's gone to 4.0597. It's actually a better, it is a healthier growth rate. Then we see capital gearing ratio, average of equity share capital and average of fixed interest bearing. Then this also has been roughly consistent throughout, which is a, and so from, as you can see, this is a satisfactory thing in terms of solvency analysis. The liquidity analysis, as we saw, was a problem because net working capital ratio, as we saw, was much lower than expected because they're not fully investing all their net working capital with proportion to their net assets that they actually have. So in this way, it is a bad thing, and this was not satisfactory. And the growth of current ratio net working capital has always also been bad, and also the average of current liabilities. If you take the ratio of current assets to current liabilities, that has been fine, but the other two have not been so great. So in liquidity, the company is not very satisfactory.
So I'll be talking about the summary of the findings. So the main
Yeah,
objective of the
Karthik,
study So the main objective of the study is to understand the type of cooperative societies, to understand the growth of the cooperative society over the years. So from the findings of on profitability, the return on equity of the cooperative society is above 0.8852 in the last 4 years, so which is a very good sign. And there is a continuous increase in the profit after tax and the net worth of the cooperative society. And the net profit margin ratio of the cooperative society is good, but it shows a downward trend. So there is a continuous increase in the turnover of the cooperative society and also shows an upward trend. So there is a continuous rise in the capital employed of the cooperative society and shows an upward trend. So this is the findings on the basis of solvency, and this is based on liquidity, as talked earlier by Kaushik. So what is the suggestions to the organization? So our suggestions to the organization is that in case of marketing, it should explore other markets in other parts of the country for the wider distribution channel, and increasing the online and social media presence for the reaching larger audience on base is very essential, and more flexible commission rates for retail sellers to beat private competition. So the financial and statistical analysis, we found out that increasing the profitability by increasing sales, reducing cost and improving efficiency. So improve solvency by increasing equity, reducing debt, and improving cash flow is very essential. And improve liquidity by increasing cash reserves, reducing current liabilities, and improving the working capital management is very essential for the company. So this is the bibliography that the sources that from which the data we have taken and to make this PPT presentation. And thank you so much.
Thank you so much.